Canada has a tax credit that exists in plain sight, documented on the CRA website, available to hundreds of thousands of people, and yet most Canadians will never investigate whether it applies to them. This isn't because the system is hidden. It's because the name of the credit creates an assumption about who it's for. And that assumption, more than any other factor, determines who checks and who doesn't. This is about the disability tax credit and why the gap between eligibility and awareness is so wide. The common assumption. When most people hear the term disability tax credit, they form an immediate mental image. That image is usually physical: a wheelchair, a cane, a visible marker of limitation. This is not a failure of intelligence. It's a predictable outcome of how language works. The word disability carries cultural weight. It suggests permanence, severity, and visibility. And because of that, the average person assumes the credit is designed for a narrow group of Canadians with conditions that are immediately recognizable. This assumption has consequences. It means that someone living with a chronic condition that significantly affects their daily life may never consider themselves a candidate. They might struggle with tasks that others complete easily. They might require more time, more effort, or more support to function. But because their condition doesn't match the mental image they associate with the word disability, they never investigate further. They assume the system isn't built for them. And in many cases, they're wrong. The result is a meaningful number of Canadians who may meet the criteria but never file the paperwork, never consult a medical professional about certification, and never receive a credit they may have qualified for. The system doesn't seek them out. It waits for them to come forward, and if they don't, nothing happens. How the system actually works. The CRA does not evaluate eligibility for the disability tax credit based on the name of a medical condition. It evaluates based on functional impact. Specifically, the agency asks whether a person has a severe and prolonged impairment that markedly restricts their ability to perform one or more basic activities of daily living. The word markedly has a definition. It means the person takes significantly more time than an average person to complete the activity, even with therapy, medication, or devices. The threshold the CRA uses is roughly 3 times longer than average. The list of basic activities is broader than most people expect. It includes vision, walking, speaking, hearing, feeding, dressing, and bowel or bladder functions. But it also includes mental functions necessary for everyday life. This category covers memory, problem-solving, goal-setting, and judgment. It includes the ability to manage personal care independently and to adapt to routine or non-routine situations. For someone with ADHD, anxiety, depression, or autism, this is where eligibility may exist, even if the condition is not visible to others. There is also a category for life-sustaining therapy. This applies to individuals who require therapy at least 3 times per week, averaging 14 hours per week, to support a vital function. The most common example is insulin therapy for type 1 diabetes. But the principle extends to other therapies that are essential, time-consuming, and ongoing. Eligibility is not self-declared. It requires certification by a qualified medical practitioner. The form used is called the T2201 Disability Tax Credit Certificate. It must be completed by a doctor, nurse practitioner, psychologist, occupational therapist, or other qualified professional, depending on the nature of the impairment. The practitioner must attest that the condition meets the CRA's criteria. The form is then submitted to the CRA, which reviews it and makes a determination. Approval is not automatic. The CRA may request additional information. It may deny applications that do not meet the threshold. The process is administrative, not emotional. What matters here is understanding that the system is designed around function, not diagnosis. Two people with the same condition may have different outcomes. One may qualify, the other may not. The difference is not the label. It's the degree to which daily life is affected in a measurable, prolonged way. Nothing in this explanation replaces the judgment of a qualified medical professional or the CRA's review process. Why awareness is so low? If the credit exists and eligibility is broader than most people think, why is awareness so low? The answer is structural. There are several points of friction that prevent information from reaching the people who might benefit. First, the credit is non-refundable. That means it can only reduce taxes owed. If someone has little or no taxable income, the credit provides no direct benefit to them, though it can be transferred to a spouse, common law partner, or supporting family member. This feature is not widely understood. Many people assume that if they don't owe taxes, the credit is irrelevant. They stop investigating. They don't realize the credit can be used by someone else in their household. Second, the process requires medical certification, and that introduces a bottleneck. Doctors and other practitioners are often reluctant to complete the T2201 form. It's not a clinical task. It's administrative. It takes time. It requires the practitioner to make statements about functional capacity that may feel subjective or difficult to quantify. Some practitioners are unfamiliar with the form. Others are cautious about certifying a condition they believe may not meet the threshold. The result is that patients who ask about the credit may be told no, not because they don't qualify, but because the practitioner doesn't want to engage with the paperwork. Third, the CRA does not actively promote the credit to individuals. It publishes information. It provides forms, but it does not send letters to people with certain diagnoses suggesting they apply. The system is passive. It assumes that those who qualify will learn about the credit through other means, tax preparers, advocacy groups, word of mouth, and will take the initiative to apply. For people who are not connected to those networks, the credit remains invisible. Fourth, there is a general lack of public education about non-refundable tax credits and how they work. Many Canadians do not understand the difference between a deduction and a credit, or between a refundable and non-refundable credit. They do not know that credits can be transferred, or that they can be claimed retroactively. This knowledge gap means that even when someone hears about the disability tax credit, they may not understand its mechanics well enough to pursue it. These factors combine to create a situation where eligibility and awareness are misaligned. The credit exists, the rules are published, but the information does not flow efficiently to the people it might apply to. Financial implications. The disability tax credit is a non-refundable federal tax credit. In recent tax years, the federal credit amount has typically been in the range of $10,000. The credit is applied at the lowest federal tax rate, which is 15%. That results in a federal tax reduction of roughly $1,500 per year. Most provinces and territories also offer a corresponding disability tax credit. In Ontario, for example, the provincial amount has typically been in a similar range, applied at a rate of just over 5%, resulting in an additional $500 in provincial tax savings. Combined, the annual value has generally been in the range of $2,000, though this varies by province and by individual tax situation. If someone is approved for the credit and their condition has existed for several years, they may be able to claim the credit retroactively. The CRA allows adjustments to previous tax returns for up to 10 years, depending on the circumstances. If the condition meets the criteria for those years, and the T2201 is certified accordingly, the individual may receive a lump sum adjustment. The size of that adjustment depends on how much tax was paid in those years and whether the credit was already claimed or transferred. It is not a guaranteed amount. It is a recalculation based on past filings. The credit can also be transferred. If the person with the disability does not have enough taxable income to use the full credit, it can be transferred to a spouse, common law partner, or supporting person, such as a parent. This makes the credit relevant even in cases where the individual themselves pays little or no tax. Beyond the tax credit itself, approval for the disability tax credit unlocks access to other programs. The most significant is the Registered Disability Savings Plan, or RDSP. What a rational person should do. If you believe your condition, or the condition of someone in your household, may result in a marked restriction in daily functioning, the rational next step is verification, not assumption. That means obtaining the T2201 form from the CRA website or through your CRA My Account portal. It means scheduling an appointment with a qualified medical practitioner who is familiar with your condition and can assess whether the criteria are met. It means being prepared to provide specific examples of how the condition affects daily tasks, how long it has persisted, and what therapies or supports are in place. If you found this explanation useful, consider subscribing. This channel exists to explain how systems work, not to sell you outcomes. There are no guarantees here, only information.